After sounding the alarm for half a year, the Federal Reserve finally acknowledged this week that inflation could actually be a problem in the near future. Recognizing the issue is the first step, sure, but dealing with it is a whole different story. The economy has grown dependent on cheap and easy money, and moving away from that is going to be painful. We've all gotten used to the jokes about money printing and the stories about shortages pushing up prices, but now it's time to ask if the system can be fixed. If you've followed discussions about the Fed, you'll know that technically, yes, they could end this inflation problem almost overnight if they really wanted to. But doing so would require such extreme measures that the solution might actually be more damaging than the inflation itself. That's the core of the dilemma we're facing. People see prices rising every day and wonder why those in charge aren't acting more aggressively. But it's not that simple. Imagine for a second that you suddenly became the chair of the Federal Reserve. Congratulations. But here's the catch. What the Fed does is far more complex than it appears. Most people assume it's just about raising or lowering interest rates. While that's partly true, they don't just flip a switch. Instead, the Fed uses various tools to influence broader interest rates across the economy. One of the most important tools is the bank rate, which is the interest the Fed charges to commercial banks when they borrow money. If the Fed raises this rate, borrowing becomes more expensive for the banks, which then gets passed on to consumers. That leads to fewer loans being taken out, which means less money flowing through the economy, helping cool inflation. It's a straightforward concept, but with big consequences. The problem is that raising interest rates doesn't just reduce inflation, it also makes debt more expensive. If you're looking to buy a car or a home, your monthly payments go up. If a business wants to invest in growth, a higher loan cost might make that project too risky. Real estate in particular feels the impact the most because so many homes are bought with interest-bearing mortgages. Even a small increase in mortgage rates can lower how much people can afford to borrow, pushing down house prices significantly. And since real estate is tightly linked to employment and consumer confidence, a drop in housing prices can shake the economy. It's even worse considering the current shortages in construction materials and uncertainties in the rental market. A major housing disruption now would be dangerous. So if raising interest rates causes this kind of widespread disruption, what other options does the Fed have? One major tool in its arsenal is what's called open market operations. This refers to the process where the Fed creates money out of thin air and uses it to buy financial assets, typically safe ones like government bonds. These purchases pump new money into banks, which can then lend more to businesses and the government. Ideally, this increases economic activity and prevents a collapse. During the pandemic, the Fed took this strategy even further by also buying corporate bonds, riskier assets than they usually deal with. This approach is known as quantitative easing. It helps stabilize the economy by putting more money into circulation and supporting companies during tough times. But there's a limit to how long you can keep this up. Over the last couple of years, the Fed's balance sheet ballooned to more than $8 trillion. Now comes the tricky part, unwinding all of that stimulus without triggering chaos. The opposite of quantitative easing is quantitative tightening, where the Fed starts selling the assets it bought, pulling money out of the economy. In theory, this reduces inflation, but dumping trillions of dollars in bonds into the market all at once would crash their value. It would also make it harder for both businesses and the government to raise money because investors would demand higher interest rates in return. Higher interest rates would make it more expensive for the government to borrow money, increasing national debt problems. And for businesses already dealing with supply issues and rising costs, losing access to affordable loans could be a death sentence. If companies can't borrow to stay afloat, they shut down. That reduces the supply of goods and services, which ironically could lead to more inflation, the very problem the Fed was trying to fix. It's a lose-lose situation. Trying to fix inflation too aggressively could trigger a recession, mass unemployment, and a deeper crisis. So how do you avoid setting off a financial bomb? You do it slowly and carefully. You back away like someone trying not to startle a wild animal. That's why the Fed has been so hesitant to act quickly or aggressively. They know the risk is massive. Even before the pandemic, the Fed was still trying to unwind its response to the 2008 financial crisis. And now, after going even further out on a limb, they're stuck holding massive amounts of lower quality corporate debt, much of which they may never be able to sell without taking huge losses. They're cornered. Drastically increasing interest rates or selling off too many assets would do more harm than good. So what's the Fed to do when every solution causes more problems? Sometimes the least bad option is just to tolerate higher inflation for a while. It's not ideal, but compared to crashing the stock market, tanking the housing sector, or causing government debt to spiral, it might be the safest route. Still, this raises another question. If the Fed has accepted that inflation is going to stay high, why did it deny it for so long? That has everything to do with managing public perception. One of the most powerful tools the Fed has is not interest rates or asset buying, it's communication. Because if people think inflation is coming, they start acting like it's already here. That means spending money faster, avoiding saving, and pushing up prices themselves. It becomes a self-fulfilling prophecy. You've probably felt this yourself. Maybe you thought, I might as well buy this now because my money won't go as far later. That behavior, repeated by millions of people, adds fuel to the inflation fire. So if Jerome Powell had gone on national television and bluntly warned about incoming inflation, it could have triggered panic, worsening the very problem he was trying to fix. It's like a medic yelling at a patient, "You're going to die." It might be true, but it's not helpful in that moment. That's why the Fed tried to play it cool, saying inflation was transitory, even when signs pointed otherwise. They needed to maintain calm and avoid spooking the markets, even if it meant losing some credibility along the way. But here's the silver lining. We might not be in deep trouble just yet. If things continue to stabilize, if businesses reopen fully and supply chains recover, the worst-case inflation fears might not come true, at least for everyday consumer goods. The bigger risk could be in asset markets like housing and stocks, where prices have soared and could be overdue for a correction. We might have to accept that the inflation target quietly moves from 2% to something like 3% over the next few years. It's not perfect, but it's manageable, and far from the kind of runaway inflation we've seen in places like Zimbabwe. And for those wondering whether the Fed makes money from the $8 trillion in assets it holds, that's a valid question. But profitability isn't the main goal. Their mission is to maintain stability. And right now, that means walking a tightrope where every step must be measured, slow, and deliberate. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.